For 15 years, money was virtually free. Entire business empires, housing booms, and household budgets were built on the assumption that borrowing costs would stay near zero. Now, the math has changed. Borrowing costs are hitting levels we haven't seen in a generation. From families trying to afford a week's worth of groceries to Wall Street traders watching their portfolios bleed, there is a very real anxiety gripping the economy as we look toward 2026. The question is no longer about a return to the past, but about the price of the future. The United States economy is currently exiting the steepest interest rate hiking cycle in 40 years. This was a calculated move by the central bank to shock the financial system and force it to slow down. Right now, we are sitting in a tense holding pattern. Homebuyers, business owners, and investors are all caught in a vacuum of certainty, waiting to see if the Federal Reserve will retreat and cut rates or hold the line. To figure out exactly where your wallet will be in 2026, we have to trace the chain reaction the Federal Reserve has triggered right now. It all traces back to Federal Reserve Chairman Jerome Powell and a commitment to take a hard, unyielding line against the economy. This illustrates how the Fed's primary weapon works. By raising the federal funds rate, they effectively drop a heavy weight that crushes economic demand. For over a decade, this rate was near zero. Then, in just months, that flat line violently spiked upward. The Fed is actively trying to make it harder to borrow and spend. They are willing to inflict pain and even trigger job losses because they believe runaway prices are more destructive. The trigger for this response was inflation. When prices first started climbing, policymakers dismissed the data as a temporary blip, calling it transitory, but it didn't fade. The surge in everyday necessities became impossible to ignore, straining local communities and draining household budgets. The Federal Reserve operates on a strict mandate to keep inflation at exactly 2%. They refuse to reverse their policy until the data reflects that specific number. Because inflation acts as an invisible tax on the working class, the central bank is determined to break it, even if it risks breaking the broader economy in the process. When the Fed raises that macro baseline rate, the cost of borrowing for everyday consumers immediately jumps across the board. High mortgage rates have stalled the housing market, sending application numbers to their lowest levels in years. At the same time, the minimum payments on variable rate credit cards have surged, hitting families exactly as they deplete the last of their pandemic savings. There is one positive flip side to this math. For the first time in over a decade, traditional savers are actually earning a measurable yield on their cash deposits. But the era of cheap consumer debt is over. Households are now forced to make difficult choices between essential daily expenses and their long-term financial health. On Wall Street, higher rates change the incentives for investors, removing the safety net from the stock market. For years, cheap money allowed corporations to borrow billions just to buy back their own stock, while unprofitable tech companies enjoyed inflated valuations. As the famous investor saying goes, you only find out who is swimming naked when the tide goes out. With borrowing costs rising, companies can no longer rely on endless debt. They have to survive on real revenue and profits. We already saw the fragility this creates in the banking system, exposed by the sudden collapse of highly leveraged institutions like Silicon Valley Bank. The financial system is undergoing a massive correction. We are returning to an environment where taking a risk carries actual consequences. Based on how inflation and the labor market interact over the next few years, the data points us toward 3 objective scenarios for 2026. This branching timeline shows the potential outcomes. The top path represents Scenario 1, a soft landing. Here, inflation successfully cools to the 2% target, allowing the Fed to gradually lower rates without sparking a recession. The middle path is Scenario 2, higher for longer. In this outcome, the economy remains stubbornly hot, forcing the Fed to maintain high rates and squeeze borrowers for years. Then there is the bottom path, Scenario 3, a hard landing. Inflation remains entrenched, forcing the Fed to keep the sledgehammer down until the labor market breaks and triggers a recession. Ultimately, the precise outcome in 2026 depends on how much pain the American labor market can absorb before it fractures. Whether rates eventually fall slightly or remain high, the 15-year stretch of cheap credit is over. Do you think the Fed will cut interest rates in 2026, Or will rates stay higher for longer? Tell us what you think in the comments.